This is Taking Stock on Bloomberg. I'm Pimm Fox. Oil rose today from its lowest level in the year. What, if anything, would spur oil prices higher, except perhaps the ambition of some oil prospectors? Well, Mark Gilman covers oil and oil companies for Benchmark Company. He's an expert when it comes to energy. Mark, a pleasure. Thank you so much for being here.
Pimm, it's my pleasure.
Let's talk about the differential between West Texas Intermediate and Brent. I was talking to Patrick Daniel, chief executive of Enbridge. He says there's this, what, $20 gap that exists between...
Well, 22, 23 to be precise,
okay,
but we're in the ballpark.
Very good. Why does this gap exist? I thought that oil was a global commodity.
Pimm, it is indeed a global commodity, and the one outlier is the U.S. market, and to a certain extent, certain Canadian crudes that are priced off U.S. as a reference price. The issue here originally had its origins with an accumulation of stocks at Cushing, whereby, as a result of the inability to get crude from Cushing, with increased flows coming from places like the Bakken in North Dakota, stocks accumulated to record levels. You couldn't move it out of Cushing.
Physically, just get it out there.
Recognizing that it's the settlement point for the NYMEX contract, you could not get it out of Cushing to the Gulf Coast refining district. Well, that's part of the answer. But now, since Cushing stocks are down 30% from the point at which this spread was half of what it is right now, obviously it's not the full answer. The fuller answer, and the one that we will have to be dealing with over the longer term, is the fact that as a result of changes in the supply side of the equation here in the U.S. and North America, we now have an emerging surplus of light sweet crude relative to the refiner diet for that crude, which has gone in an increasingly heavy direction, particularly on the Gulf Coast. So that the ultimate answer is not necessarily dealing with the Cushing issue. The ultimate answer is to get that crude to the East Coast, which is where the appetite for this crude is. There is no way to do that right now outside of very expensive alternatives. And until we do that, we're going to see something close to a very sizable differential persist well into the future.
Who benefits from that? Refiners who can charge?
Mid-continent refiners are benefiting from it, because the important thing to understand is that the world market is based upon Brent.
Right, they get that, that's the price.
Product prices are based upon Brent, because we in the U.S. are a net importer. Therefore, it is the price of imported product sets the price here. So if you are a refiner with access to locally produced WTI or WTI reference crude, you're earning a windfall.
Tell me about some of the refiners. Do you like some of the stocks? Tesoro, for example?
We have a buy recommendation on Tesoro currently. In part, it has to do with our expectation that a differential will persist to the benefit of their the mid-continent portion of their system. The recommendation, though, on that one in particular, Pimm, is a little bit more broadly based, because as a result of this windfall, which has some duration to it, it will transform the financial characteristics of the company such that, in our view, in a relatively short period of time, A, they'll be able to reinstate the dividend that was suspended back in 2009, and B, they will be awash in cash to the point that they will be buying their stock back at in a reasonably significant amount.
Shrinking the float, increasing the dividend.
Shrinking the float, increasing the dividend. The shares currently, if you measure them on the basis of the refining margin environment that they are pricing in, are selling at a level that's in a refining margin environment about $1 a barrel below mid-cycle kinds of levels.
I want to get your thought on some big oil companies. For example, Total. You like the shares?
Total shares, from a strictly fundamental standpoint, might very well be the most undervalued stock in my universe of coverage. However, there are what we would broadly call technical impediments to correcting that valuation anomaly, associated with the fact that the company is French, that the price of the shares is set on the CAC in Paris by virtue of the lack of a U.S. and/or U.K. listing. And frankly, until some movement occurs on that subject, and I think that the issue is front and center in terms of the management, some of this differential is still going to persist, notwithstanding the fact that from an upstream portfolio and an asset perspective, this might be just about the best the industry has to offer, perhaps rivaled only by that which Chevron has to offer. So that it's a longer-term, type of opportunity, if in fact there are any longer-term investors still out there.
I'm sure there are. I want to thank you very much, Mark Gilman. Always enlightening. Thanks for sharing your insights in the oil industry. Mark Gilman, Benchmark Company.
Thanks, Pimm. Always a pleasure.
Thank you very much.